Hello and welcome to this video. In this video, we are going to basically take a look at a way to make money trading options. Now, in my opinion, this is one of the best ways and most consistent ways of making money trading options. And we will look at the exact step-by-step process that is to be used. I have more detailed videos on each of the steps detailing the process with live examples. Before we proceed, let's go through the disclaimer once. So, whatever information I'm sharing with you is based on my experience, it's my opinion. It is not any kind of trading or investment advice. So, let's get into the details. And I'm going to try and keep things very, very simple. Uh, Trading is all about keeping things simple. If you make trading very complicated, you're not going to be successful because once trading is complicated, then it's very difficult to understand what your positions are and what needs to be done. So I don't believe in complex strategies just because they sound pretty hi-fi, because you have big terminology involved in those strategies. Those strategies normally don't work. If you're trying to drive a car, you just need to know how the car operates. You don't have to go through the manual of an airplane. And even if you do that, going through all the gauges and all the instrumentation that is available in an aircraft, that doesn't mean you're going to successfully even drive a car. For driving a car, you need to have your knowledge specific to driving a car, and that's all about keeping it simple. So, with that in mind, we will look at the first step. The first step is outlined here, which is basically identifying stocks on sale. Now, what do I mean by this? One of the biggest issues that I see with traders, with investors, is that they will look for stocks that are doing well, and there's nothing wrong about it. So they will look at stocks which are in an uptrend, and then when that uptrend is going strong, they will go and buy those stocks. There is one inherent problem with this strategy, and the basic problem is that when a stock is going up, it's in an uptrend. uh, Riding the trend is a good concept, but only if you get onto that uptrend at the right time. If you're too late, then you're going to basically end up buying at the top. And that is something which we want to avoid, because stocks never go up in a straight line. They'll go up, they'll have a correction, then again they'll go up. And in between, there are chances that the stock falls or dips for some reason. It could be something, some event specific to that particular stock. It could be an event specific to the country in which the stock or the company is based. It could be something specific to the industry or sector in which the stock is based. So, because of these different reasons, there's always a chance that a stock can dip down. And if you are buying at the top, if you're caught buying at the top, then you're in trouble, because now you've bought at the top and it's going to take a while for the stock to basically recover from its losses and then come back up. So, why do that? Why buy at the peak? The only way to make money with trading or investing is to buy low and sell high. So, why would in the first place I intentionally go and buy something which is not at its uh, at least a short-term low? It's at its high. It doesn't make sense to me. Yes, I understand the concept that things which are going up can go up further, and therefore, if you are certain that a stock is an uptrend, then buying in is basically giving you a possibility of riding that uptrend further. But there's a big assumption here that a stock which has already gone up, let's say 10, 20, 30%, the biggest assumption behind this concept of trading is that although it's already up 20, 30%, it's going to continue going up another 30, 40%. So for me, that is something which is not a good start. I don't believe that getting into trading or investment positions when a stock is already trading towards close to its highs is a good idea. So that is why the first step that I use is always to identify stocks that are on sale. And what do I mean by stocks that are on sale? So I have a detailed video on the step-by-step process that I use, the screener that I use to basically get the list of stocks that are on sale and which can be part of my further analysis. I'll leave a link to that in the description, and you can watch that to get an idea about the step-by-step process. It's a practical example on a particular day. How do I actually scan through the stocks and narrow it down to 15, 20 stocks, which I can then analyze further, and I narrow it further down to two, three actual trading or investment opportunities. And then based on the size of your trading account, you can pick one or more of those stocks to actually get into a trade the next day, provided you see the desired setup. So identifying stocks on sale is extremely important. I don't like dealing with very small caps, penny stocks, because they're very volatile. And these companies, every day you have tens of these companies coming into the stock market, and tens of these companies move out of the stock market. So I don't believe in trading them. I like to trade stable companies, companies which are part of the S&P 500, because to become part of an index, the company has to have certain history, they have to meet certain criteria, they have to be a strong enough company to be representative of their sector, their industry in the index. So I basically like to deal with stable companies which have done well in the past and which have a decent future growth potential. But for some reason, it could be a new specific to that company. It could be just that some hedge fund is pulling out their funds from that company. It could be a global phenomena like the coronavirus pandemic or some other reason, but for the time being, the stock is trading at a discount. It's taken a recent dip, and those are the points where I like to get in. And this is what usually smart money does. This is the very concept that differentiates the smart money or the professional money from the regular retail trader who is consistently losing money. And the concept is the same. When retail traders see a stock going up, then they wait, and then because of that fear of missing out, they end up buying or getting into that position right at the top or close to the top. And at that time, the smart money is actually sitting on the sidelines because they know that the stock has already moved up. They are up on their position, so why would they buy more at a higher price? They know this is not the right price to buy. But whenever the same stock takes a dip, the retail trader would panic and they would get out of their position to minimize their losses, whereas the professional money would see that as an opportunity to add more position to lower their cost basis. So you can see this the market presents the same opportunity to everybody, but the difference between a professional and a novice is very clear. A novice is gonna buy high and then sell at a lower price in order to reduce or cut his or her losses. Whereas a professional, on the other hand, is not going to buy high. That's the first concept. When they see something is already in an uptrend, they are not going to buy high. They are basically going to buy on a dip when the stock is trading uh, at a lower price. And whenever stocks dip, that is where they keep the cash at hand so that they take it as an investment opportunity, as a trading opportunity, rather than as a source of panic in which they actually end up losing money on their positions. So this is the basic concept. You need to identify stable, reputed stocks which are trading on a discount right now, that they are on sale. And this concept is very similar to the way we shop around in our day-to-day lives, but somehow when it comes to trading, this concept just goes out of the window. A lot of traders feel that they need to observe a stock for an uptrend, and I mean something which was consolidating and it's already moved up by 10-20%. If you're getting in after that 20% move, then it's common sense to understand that probably the upward move for the timing is already done, and now it's time for another correction. Even if the upward move is remaining, a significant portion of it is probably done. So this is the first concept I want to drive through, that personally I do not want to assume. I don't like assuming that a stock, because it's gone up by 20-30%, it's going to continue going up by another 30-40%. I don't want to work with assumptions. I don't want to work with expectations and hope. I want to work with what the market is telling me. If I see a stock trading at $200, but today it's available at $150, then I know this particular stock has the potential to go up to 200 because it's been there. And if there's nothing really wrong with that company, it's a temporary correction, then getting in at $150 is a really good bet because fundamentally there's nothing wrong with the company. The stock has shown previously that it can touch the $200 mark. If it's trading at 150, that means the stock is available at a 25% discount. I would go in and take a position there. So this is the first concept that I use in my three-step formula for trading options profitably. The second concept that I want to drive through is that the only way that you can consistently make money trading options is by selling option premium. Now, I said the only way, and I also said consistently. So I'm not saying that if you buy options you cannot make money, but that approach is not going to be consistent. And the concept for that is really simple. When you are buying options, you're basically buying a call or a put option, so you expect the price to go up or down. If the price does not go up and down, you lose all the premium that you paid to buy those options. So, in my opinion, when you are taking a directional trade, when you are buying an outright call or an outright put, then you are expecting the stock to make a move. And then again, you get into that mode, as I said earlier, you expect or you hope that the stock is going to do something. Uh, we are better off with situations where instead of expecting the stock to go up or down, we put ourselves into trades that will make us money even if the stock does not do anything or it does something against us to a certain extent. And that strategy can be achieved by selling option premium because when you sell option premium, the one thing that always works in your favor, which cannot go in a backwards direction, is time decay. Time will always move in the forward direction. And therefore, what happens when you sell option premium is that even if the underlying stock does not make any kind of a move, that time decay is eating away the premium, and that's the money that you keep making every single day. So, the second concept is that you need to be a net seller of option premium. Now, I'm not saying the only way to go about it is selling naked puts or covered calls. But in one way or the other, you need to be a seller of option premium. If you're a net buyer of option premium, then you have the time decay working against you because as long as the stock doesn't make the move that you want it to, the option premium is daily getting eaten away because of time decay, and somebody else who sold you that option is actually making money. So, uh, buying calls and buying puts can be very profitable, but that most of the times is not consistent. It's more to do with a certain to a certain extent it deals with you being lucky because when you're buying calls and buying puts, you're expecting the stock to move up or down, and there's no guarantee, there's no certainty. None of us can influence what the stock is going to do tomorrow, in a week's time. And the biggest problem with buying options is that if you've bought an option, a call option, let's say, which is going to expire in the next 30 days, then you don't just need the stock to go up, you need the stock to go up within the next 30 days because options have an expiration, and the underlying move that you expect should happen within that time frame. But on the other hand, if you're selling the same option, then the stock has to move against you within 30 days for you to lose money. If it doesn't do anything, or even if it moves against you after 30 days, you get to keep the entire premium. So that's the difference. I mean, if you look at the two scenarios, if you consider yourself uh, as an option buyer versus yourself as an option seller, you will see that being an option buyer, you need to have a certain set of events happen within a definite time frame for you to make money. Whereas as an option seller, you just don't need anything specific to happen. You don't want an absurd movement, a really huge movement against you. So as long as that is not happening, you are in the driver's seat and you're going to make money consistently, slowly, day by day, based on the theta decay or the time decay that's going to happen on the option premium. So for this, I basically recommend two strategies. These are selling naked puts and selling the covered calls. Now, I personally use covered calls, and I also use a variant of that, which is called the synthetic covered call. So, um, but the basic point is that you need to be a seller of option premium. You cannot be a buyer of option premium. Most of the options that are sold, there's a study I think out there where about 80-85% of the options that are sold, they expire worthless. So what does that mean? That 85% of the options which are being sold by sellers, the sellers get to keep all the money. On the other hand, 85% of the options, when option buyers who are holding those options, they lose that premium because the options never end up getting exercised. They are never in the money. So it's very clear that you need to be a net option seller in order to consistently make money. And that is rule number two. And the third rule is basically rinse and repeat. So you need to always remember rule one, you need to always remember rule two, and then you need to continuously repeat that. And the second, the third thing here that I want to highlight basically with this step is that you need to repeat the process. You don't have to repeat it with the same set of the stock. The reason is, let's say I'm trying to look for positions to take in the month of March. Then I'm going to, based on my step one, I'm going to identify 5 or 6 stocks which are on sale in that particular beginning week of March. So those stocks may no longer be at sale when by the time I reach April. So every month you have to open new positions and then you need to close these positions when the options expire. I usually end up trading monthly options. So for me, for example, I would open positions in March based on the stocks which are trading at a discount in March and the beginning of March. And then by end of March, those positions, those options would expire. So I would kind of close those positions. And if the stocks are no longer trading at discount, then I'm going to open new positions in April on different set of stocks which are now trading at a discount, which were no longer trading at a discount earlier, but now they are trading at a discount. So you have to shuffle between one stock and the next stock. You can't be married to stocks. You can't be telling yourself, I like so and so stock, so I'm only going to trade in this. You have to switch from one stock to the other depending on the kind of opportunities and the valuation those stocks are providing at the moment. So if you can follow these three steps consistently, that's a sure short way in the long run to make consistent monthly income. You can do it on a shorter time frame. A lot of stocks are there which have weekly options. So if you're not comfortable waiting for an entire month to see the performance of this process, you can actually sell weekly options as well. Now, keep in mind if you're doing it on a weekly basis, and your broker has commission charges, you're going to be paying more commissions because you're going to basically be executing more trades. So if you don't want to do that, you can try out the monthly options, or then if you're on a zero brokerage account like Robinhood or Webull, then that also makes sense. So I hope this particular video was useful, and I will, for each of the steps 1 and 2, I have detailed videos. Step 1 with detailed examples for a complete day's analysis, how I arrived at stocks on sale for that particular day. And for step 2 also, I have a live example of a naked put trade which I executed, and how I basically have uh, the option premium expiring, and I'm making money on a daily basis as the option premium expires, as the option approaches its expiration date. So I will leave those links in the description. And if you have any queries around this particular process, or you want more examples, you want examples of any specific stocks or any specific sectors, please do leave those requests in the comments. And your suggestions, comments otherwise are most welcome. So thank you. Please subscribe to the channel. And if you like this information, please share it with your family and friends. And thank you so much for your time. And I'll be in touch with you in the next video. Thank you.